Here's an example of a cash flow statement, again from Chapter 6. So Chapter 6 is your one-stop shop for financial statements. And think of the cash flow statement as a kind of a reconciliation of where does my cash come from, and then where does my cash go. So you can see we start out with our beginning cash number. I'm just going to pick on the January column and work our way down. So beginning cash, and then for the month of January, I have cash coming in, right? So most businesses are selling goods for cash on the spot. And if you're selling goods on account, collecting then on those receivables. So I've got a combination of just cash sales and collections here. Also, of course, you have other areas where cash is coming in. If you've got money in the bank earning interest revenue is coming in as cash. Or maybe I sell something, or I sell some other type of an item, like I might sell some old property, plant, and equipment that I don't need, and that would be cash in. So, but obviously sales and collections on sales on account would be kind of the biggest pieces for most businesses of where cash is coming from. And then I've got cash payments, specifically here payments for cost of goods to be sold. So purchasing of material, I'm buying raw materials and I'm going to take them and turn them into something, and then use labor, of course, to manufacture those goods. If I'm a retailer, think like a grocery store, I'm just buying goods that are already made from my suppliers, putting them on my shelves and selling them. If I'm a manufacturer, I'm buying raw materials, and then I've got labor who is turning that raw material into some kind of a product or finished good that I will then sell to my customers. But either way, it's cost of goods sold. Then I have variable expenses and fixed expenses, and this represents cash paid for those expenses in the month of January. So cash payments towards advertising, freight, and so on. Cash payments for the fixed costs, insurance, licensing, salaries, rent, and so on. So we're just dividing the cash payments of expenses between three categories: cost of goods sold, variable, and fixed. Then I have miscellaneous kind of other items down here, federal income tax payments. If I had interest expense, if I had loans, if I had debt, I'd pay interest expense right there, and so on. Owner draw, the owner taking money out of the business. Loan payments would go into here. Okay, and that shows us then how did my cash balance change. And then in this example, I borrowed some money in the month of January, $65,000, which is money in, to get down to $72,840. In this example here, if you look out some further months, the owner put some money into the business, an equity deposit from the owner of $5,000 and $5,000. That $72,840 you see down here, I'm going to show you then becomes the beginning number for February. So just kind of think, work your way down. My ending January number becomes my beginning February number, and so on. So that's just the way that works as you kind of scroll down and look at that. So really just where does my money come from and where does my money go, organized between cost of goods sold, variable expense, and fixed expense, purely on a cash basis. Cash in, cash out, which is different than the income statement, which would use more the accrual basis, focusing on more of the earnings process on the revenue side. You can earn a revenue but not actually receive the cash. On the expense side, you can incur an expense but not actually pay for it. Whereas in the cash flow statement here, I'm only focused on cash in and cash out. Nothing gets here into this statement unless it actually represents true cash in or true cash that went out. Okay, so Chapter 6 is your one-stop shop. Take a look at that and read the information in Chapter 6 also.